Welcome to the Indicator Masterclass, your simple guide to technical indicators. Imagine a moving car turning on its right indicator, signaling it's about to turn right while still moving. Market indicators work the same way, showing signals based on price action. In this video we'll cover lagging, leading, and hybrid indicators, plus how to combine them with price action. Let's start with the first group, the lagging indicators. The lagging indicators follow price. They react once a move is underway, confirming the trend's power. They help you confidently ride strong trends and avoid second-guessing your trades. While they may not predict reversals early, they keep you in winning moves longer. Think of them as your trusted guide, showing clear momentum so you can trade with confidence. Let's explore the key lagging indicators and how to use them for smarter trading. The simple moving average calculates the average price over past periods, giving equal weight to each. For example, a 20-period SMA averages the last 20 closing prices and updates with each new candle. Traders use common periods like 20 for short-term, 50 for medium-term, and 200 for long-term trends. Price crossing above the SMA may signal a bullish trend, while crossing below suggests bearish momentum. The SMA helps spot momentum, support, and resistance to guide trading decision. Now, let's understand the exponential moving average. Unlike the SMA, it gives more weight to recent prices, so it reacts faster to changes. For example, a 20-period EMA updates by emphasizing the latest closing prices, capturing momentum quicker. Traders use the EMA to spot trends early, identify support and resistance, and generate signals. Like the SMA, common periods are 20 for short-term, 50 for medium-term, and 200 for long-term trends. Price crossing above the EMA suggests bullish momentum, while crossing below indicates bearish pressure. Let's talk about the MACD. That's Moving Average Convergence Divergence. It's a momentum indicator that uses two EMA, the 12-day and 26-day, to show momentum. The MACD line, which is blue in color, is their difference. The signal line, orange in color, is a 9-day EMA of the MACD line. When the blue line crosses above the orange line, it's a buy signal. When it crosses below, it's a sell signal. The histogram shows momentum strength. Green bars mean it's rising, red means it's fading. Traders use these signals to confirm trends and decide when to enter or exit trades. Now let's understand OBV, on balance volume. This indicator adds volume on up days and subtracts it on down days. If price is rising and OBV is also climbing, it confirms that buyers are in control. If price rises but OBV is falling, that's divergence, and it's a red flag. Smart traders use OBV to validate breakouts, spot hidden weakness, or confirm a true trend. You can trade stronger when OBV supports the price move, or stay cautious when it doesn't. So here's what to keep in mind about lagging indicators. They're not meant to predict, they're meant to confirm. They often signal after the move starts, and that's okay. They help you stay in trades longer, and avoid jumping in too early. Use them to ride strong trends, not to call tops or bottoms. And for better timing, always pair them with price structure or key zones. Now let's go through leading indicators, and what makes them different. These tools move before price, aiming to signal momentum shifts early and give you a potential head start. They can help you spot possible reversals or breakout setups before they happen. But because they act early, they're more prone to false signals and noise. Think of them as your early warning system, powerful when used with context like support, resistance, or candle patterns. Let's explore the key leading indicators and how to use them for sharper entries. Let's understand how the RSI works. It measures how fast and strong price is moving, shown on a scale from 0 to 100. Above 70, the market is considered overbought, meaning the move may be overextended. Below 30, it's oversold, a possible sign of a coming reversal. Traders use it to stay cautious when RSI goes extreme, and to look for reversals. A common trade setup is to wait for RSI to reach oversold near a support zone, then watch for price to bounce with confirmation. The same goes for resistance. When RSI is overbought near a key level, stay alert for reversal signals. Here's how divergence with RSI works. Divergence happens when price and RSI disagree. If price makes a higher high but RSI makes a lower high, that's bearish divergence. Momentum is weakening before a possible pullback. If price makes a lower low but RSI makes a higher low, that's bullish divergence. Selling pressure is fading, hinting at a potential reversal. Look for divergence near key levels, then wait for confirmation before trading, like a candle signal or break of structure. Now let's understand the stochastic oscillator. The stochastic oscillator compares the current price to its recent range. The faster moving K line shows where price sits within that range. The smoother D line averages the K line to reduce noise. When the K line crosses above the D line from oversold, it signals buying momentum. When the K line crosses below the D line from overbought, it signals selling momentum. These crossovers help traders time entries and exits, especially near support or resistance. Let's take a look at the CCI, the Commodity Channel Index. It shows how far price is from its average, acting as both a momentum and pullback tool. Above plus 100, price is considered strong. Below minus 100, it's considered weak. When CCI drops back below plus 100 after a strong move, it may be a signal to exit longs. When it crosses above minus 100 from an oversold zone, it could signal a long entry. For cleaner setups, combine CCI with trend direction and candle confirmation. Leading indicators can be misleading, especially when acted on too quickly. Just because RSI or stochastic shows oversold doesn't mean a reversal is happening right away. Many traders enter too early, and price continues to fall. A better approach is to wait for clear confirmation, like support holding, volume shifting, or a strong rejection candle. Leading tools are early warnings, not entry signals on their own. Patience and confluence turn risky guesses into calculated trades. Some indicators don't fit neatly into the leading or lagging category. These are called hybrid or supporting indicators, and they give extra context, not direct entry signals. They don't predict like RSI, and they don't confirm like moving averages. Instead, they measure volatility, trend strength, or price deviation to help you manage trades smarter. Think of them as decision enhancers, tools that help with timing, stop placement, or identifying when to avoid bad conditions. Let's walk through the most powerful hybrid tools and how to use them in real trades. Let's explore the ADX, Average Directional Index, a tool that measures the strength of a trend, whether it's up or down. It doesn't show the direction, only how powerful the move is. When ADX rises above 25, it signals a strong trend is underway, bullish or bearish. If it falls below 20, the market is likely weak or moving sideways. Traders use ADX to avoid false signals in choppy markets and focus on trading strong trends. Combine ADX with other indicators, like price breaking key levels or MACD turning bullish or bearish, to enter trades with more confidence. The Average True Range, ATR, is a tool that shows how much a price usually moves over a certain time, often 14 days. It doesn't tell you if the price is going up or down, only how big the moves are. When the ATR is high, it means the price is jumping around a lot and the market is more active. When the ATR is low, the price moves less and the market is calmer. Traders use ATR to decide where to put stop-loss orders. They place stops farther away when ATR is high to avoid being stopped out by normal price swings, and closer when ATR is low because the price doesn't move much. This helps them manage risk better. Now, let's look at Bollinger Bands. Think of them as a band around the price that expands and squeezes based on how much the price moves. If the price hits the upper band, it might be overbought and could reverse down, while hitting the lower band means it might be oversold and could bounce up. When the bands squeeze tight, it shows low volatility and signals that a big breakout move is likely coming soon. Traders use Bollinger Bands to trade either these breakouts after a squeeze or reversals when price action confirms a turn near the bands. Watching for strong rejection candles near the bands helps confirm the best times to enter trades. It's easy to overload your chart with too many indicators, but more isn't always better. Too many tools can create confusion instead of clarity. Instead, focus on using just one trend indicator, one momentum indicator, and one method to confirm your trades. Remove anything that doesn't directly help with your entry, exit, or risk management. Clean charts make for clearer decisions and more consistent results. Let's quickly recap what we've covered. Lagging indicators like moving averages and MACD help confirm trends after they've started, perfect for riding strong moves. Leading indicators such as RSI, Stochastic, and CCI try to catch reversals early, but they need confirmation to avoid fake outs. Hybrid tools like ADX, ATR, Bollinger Bands, and the Ichimoku cloud give context, helping you measure strength, volatility, and manage stop-loss placement. Remember, indicators aren't magic signals. They're decision tools. They work best when combined with structure, support, resistance, and clean price action. Congratulations, you've leveled up. Now you know what indicators really do. Lagging tools confirm, leading tools signal early, and hybrids give context. But the real power comes when you combine them with price action. You're not guessing anymore, you're making informed decisions. Keep practicing, keep studying the chart. That's how real traders grow. Next up, we're diving into smart money concepts. You'll uncover how the big players move the market, and how retail traders often get trapped. We'll break down liquidity zones, order blocks, fair value gaps, and the manipulation behind stop hunts. Don't miss the next video, it'll change the way you see the market. You'll start thinking like smart money, and trading with real precision. See you in the next video.